Hello, hello. This is the Unemployed Value Degen. I'm not giving financial advice, and I'm a few days late for my weekly recording here. It's been an eventful couple of weeks. We've been having these weekly sell-offs. We've had two Mondays. Let me go here too. 3 months. So we've had these Monday sell-offs where first it was a DeepSeek revolution came out, and then it was Trump announcing tariffs on Mexico and Canada. But then on that Friday, instead of having a Monday surprise, we had a Friday surprise. And that Friday surprise was inflation expectations. So this is the University of Michigan survey. Inflation's expectations exploded from 3.3% to 4.3%. And the market did not like that at all. But when people calmed down for a moment and took time to look at it, there was a huge partisan effect. So the Republican surveyed expected 0% inflation, and the Democrats expected 7.2% inflation, and the Democrats are oversampled. Well, I mean, what's the quality of that information? Are Republicans accurate thinking that prices are not going up? I think they're probably wrong. But are Democrats accurate in thinking prices are going to go up 7.2%? I think the only reason they thought that is because their news sources are just criticizing Trump over tariffs. And it's a frustrating phenomenon because this has the power to move markets. And you still see this huge schism where people's beliefs are shaped by their news sources. And it's such a powerful effect that the average Democrat voter thinks inflation is going to be over 7% for the next year because of Trump's tariffs. When in 2016, when he did this, it didn't cause anywhere near that kind of inflation spike. So just a bizarre result, and it led to this really huge red candle on Friday. But the markets mostly recovered from that because once people got into the data, it wasn't so scary. Let's go back to 1 year. Every time I do one of these, I start out with the 10-year Treasury, which it is up today, just a bit. Not in a big way, just a little way. There's always some volatility in the way things move, and I don't think the market's really going to be worried about this unless it starts, challenging previous highs. But what I find interesting about this is after Trump was done focusing on fentanyl, it looks like a lot of his rhetoric is focusing on the 10-year Treasury. It looks like Trump's focus now is going to be on the Treasury market and getting those rates down. Still, I'm not sure exactly how he's going to do that, but that looks to be his area of focus, at least for the medium term here. So I see a lot of people that when they interpret these events, there's so much that they think that they know. And I have a graduate degree in economics. There's a lot that I think that I know. But I keep on getting surprised by what Trump actually ends up deciding to do. And during the campaign, he talked about, in the same way that he told Mexico and Canada, hey, control your fentanyl problem or we're going to put these punitive tariffs. He's talking about going to the BRICS countries and saying, hey, buy treasuries or we're going to put a punitive tariff on you. Because he takes the move for BRICS countries to try and dethrone the dollar as a reserve currency, takes that as a threat, and he's kind of taking the Teddy Roosevelt playbook and speaking softly and using a big stick. So he's using his bully pulpit to get his way. I think it's possible he could talk the 10-year Treasury down, especially where the interest rates in other currencies are much lower. So the Canadian treasuries are lower. I think the European Union's treasuries are lower right now. I think there is a lot of room for the 10-year Treasury to come down. I think a lot of people would disagree with that, especially because, if we're thinking about what is inflation going to be, and are investors going to get a real rate of return above inflation in treasuries, even though for 15 years they didn't. If inflation is going to be 4.5%, then the Treasury doesn't have any room to come down. But let's see. These are the Let this load for a moment. So the truflation measure has been falling. It's down to 2.1%, and this measures, you know, real-time exchanges at the grocery store. I think they have tens of thousands of QSIPs that they track. So that's one thing that's happening is prices are not rising that quickly. And then you also have forward-looking rents. So there's been a huge glut of multifamily properties that have come online, and forward-looking rents for apartments are crashing. And that usually is a pretty strong predictor of what CPI is going to do. So between crashing forward rents, grocery prices not going up very much, I think the market took this survey and sold off, but I have a suspicion there's room for the 10-year Treasury to fall. And I don't want to underestimate Trump and what he's able to accomplish, because he's been able to pull some pretty incredible rabbits out of his hat. I don't want to talk about the ethics of the bully pulpit. I mean, it feels like internationally the world is moving back towards a might makes right sort of framework, which I'm not too happy about. But on the other hand, the whole rules-based order is getting exposed to be a giant grift where everybody was just lining their pockets. And that was the thesis of the book. If you guys ever read Freakonomics, the authors argued that whenever you have this veneer of virtue that allows you to hide fraud and misdeeds. So they used that thesis and they said, okay, well, the thing that has the most honor, the thing that's beyond reproach, might be something like sumo wrestling. And sumo wrestling, it's a very honor-based system. And they said, okay, based on that prediction, we'll be able to go into sumo wrestling and find fraud there. And they found it. They found that when a sumo wrestler that was older, if he loses too many matches in a row, he's forced into retirement. And as that limit starts getting close, he wins a match. So the other wrestlers, they'll throw the match. They'll lose a match on purpose to not be the guy that forces one of their older heroes into retirement. So even among, using that thesis, that whatever has that veneer of having virtue is really just a shield, and you're going to find misdeeds and fraud underneath it. So it feels like the world is moving towards this might makes right, which, you know, Machiavelli would say it's always been that way. But if the rules-based order was really just wool over people's eyes, and it was really all grift and fraud anyway, then nothing's changed. And so that's Trump going around the world and saying, buy our treasuries or else you get 100% tariffs. He might do that, and the 10-year treasury could come down a good bit. And but what is that going to do to the dollar? Now, this is an interesting day for divergence, because you have the 10-year treasury up and the dollar down. That's an amazing divergence, because most of what happens to currency strength or weakness is interest rate arbitrage. So when you have a day where there's that kind of divergence, the dollar index is down, but the 10-year treasury is up, that's worth paying attention to. I don't know if it's exactly the right time to pile into international stocks, but I still have my small position in PagSeguro, El Crasud. I haven't pulled the trigger on some of the Colombian stocks, and they've started rising. I just haven't had the disposable cash. There wasn't anything I wanted to sell. But yeah, it's an interesting world right now. I find it very interesting that the dollar is weakening while the 10-year treasury is rising. On the fear and greed index, right, we're into a neutral territory. We were at fear, I think, for the last 3 weeks. Those Monday surprises have been keeping us at fear since, you know, middle of December. That was where Jerome Powell spooked the market. And we've been at fear just about ever since. And we're only now coming back to neutral. And what does that look like on the S&P 500? So there's the middle of December that we've been at fear. And the S&P 500 did break to a new high just barely, but we're back under that. So since the middle of December, since that the time we've been at fear, historically, anytime the fear and greed index is at fear, it's a great time to buy. That tells us the market's probably going to be moving higher. And we're still in a bull market. But one thing I wanted to see here was the components. Breadth is deteriorating again. It's amazing. The put-call ratio is low, and people just are not buying puts. People are buying calls. The put-call ratio is into greed. Because I think people think in the longer run the market's moving higher. And then the VIX. The VIX hasn't been above 20 since that December 19th when the Federal Reserve spooked the market. So, I mean, this is higher than it was last summer when it was in the 12-13 range, but it's still a pretty subdued volatility index. Let's see, and I want to take a quick moment and look at the sectors, because we're now a month and a half into the year, and some interesting patterns are showing in the different sector analysis. So the information technology sector is negative for the year, 6 weeks into the year, and this is usually one of the top performing sectors. But 2023 and 2024 were just so aggressive. It wouldn't surprise me if this sector kind of took a breather this year. I don't expect it to crash. It could if the momentum catches up with it. But it's kind of amazing to see information technology, the only red sector. And you have energy right here, middle of the pack, up 5% in the last 6 weeks. The leading sectors, though, you've got communication services, healthcare, financials. But what is surprising is materials and energy being, over 5% in the first 6 weeks of the year. Industrials is not so surprising. A lot of people are pointing at consumer staples. The consumer staples outperforming is signs of a recession, and also consumer discretionary underperforming. I'm not so sure I would read into that much this time. It could have just been pent up. If you look at the 5-year performance, I mean, consumer staples was relatively due for some performance. Materials and energy, though, especially if you look at the 1 year, could do a lot of catching up. Oh God, look at energy over the last 10 years. I think energy has the biggest catch-up still left to go. I know they performed very well in 2022, but wow, the 10-year, and this isn't annualized, this is cumulative. So for the last 10 years, energy is up 17%, and even staples is up 77%, and materials is up 78%. There's no reason why that gap couldn't close in a couple of years. And that would be, 30% returns for a couple of years just to make that gap close. So I still like energy, but for the last 2 years, it has not loved me back. But for the valuations to be so low, and for it to get a good amount of momentum early in the year, and for Trump to be in the White House, so ESG is kind of in the retreat, and for oil prices to be high, energy has a lot of room to run here. All right, into the charts. So for the major U.S. indices, well, this is very little, but you could probably read a bull flag into that. Right, this is, right, a bull flag, maybe a little bull flag. It's still a bull market. It does have, I mean, it is troubling. It is troubling that about half of the time, the S&P 500, the highest level recorded, is either in January or December. Because even if the market goes up all year, the market goes down all year. There's a little nagging in the back of my brain that the S&P 500 having its high in January, I would love to see that get overtaken, just because of that statistical phenomenon that, a huge chunk of the time, the S&P 500's high water mark is in January or December. So I think a lot of people are going to be looking for the S&P 500 overtakes that past all-time high. And it looks a lot worse in the equal weight. So in the equal weight, you're still below that November reading. that's pretty brutal. And what's driving that obviously is value. Now, it is nice that it's holding out above the 50-day moving average. I think that's important. It dipped below that a little bit, but it's been staying above that. And also it's nowhere close to the 200-day. The Magnificent 7 ETF, that one is kind of a much more clear bull flag. Right? That didn't have that fake out rally. It's just a continuing pattern. So how much longer will the Magnificent 7 chop sideways before the next run of the bull market? This has only been 2 months, and sometimes this sideways consolidation for a bull flag that can go on for 3, 4, 5, 6 months. I do think the Magnificent 7 still has a lot of room to run. People make a lot of comparisons with is it 1995 or is it 1999? I think we're probably about 1998. I think we've got a couple solid years of an aggressive run-up in large tech and in the artificial intelligence situation before we get to any sort of a crash. So I would think that the Magnificent 7 is going to maybe spend some more time consolidating, but it's going to be another bull run after that. But I'm a value degenerate, and I love value. And this value chart is pretty ugly. It doesn't quite have the same shape as a bull flag, and it's not like the equal-weighted S&P 500. It's not staying above the 50-day moving average as well. So this is not fantastic, which is surprising because you have consumer staples up for the year. Not a leading sector, but a strong sector. So I don't know what to make of this. I don't like that the large cap value stocks are not really able to spend that much time above their 50-day moving average. And the MACD, right, is turning into the negatives. That's a little troubling. The RSI isn't telling you too much. And I think it has to do with, so Trump is a pretty big factor for uncertainty in the market. And I think uncertainty does weigh on multiples. So if the entire market loses, one turn on the price to earnings ratio because of this new era of uncertainty, because nobody knows what Trump is going to do from one week to the next, that's a painful time. And that might be what the market has priced in here just in the last few weeks, with value being unable to stay above its 50-day moving average. Let's go to 3 months. See if we can see these Monday surprises. So value didn't really have that shock, right? With DeepSeek wasn't a problem for value, but the tariffs were. So this is the Mexico-Canada tariffs, this is DeepSeek, and then this is that Friday inflation report. And that is a hammer candle. So that is a pretty bullish phenomenon. I mean, you get them once in a while, but, and I've talked about this before, a hammer candle is when the market starts out high, then over the course of the day it sells off, and then once the sellers have lost momentum, the buyers take over, and the price closes pretty much where it opened, but the buyers have gained momentum. And so that was Monday of this week. That's a pretty encouraging sign. So yeah, I still think, especially with the fear and greed index at neutral, I think we're off to the races. I don't think there's much that's going to challenge this market until maybe selling to pay taxes in April. But then again, we keep getting these Monday surprises, so we'll have to see. Last time I made one of these videos, I looked at the stocks that my allocation is full and I don't want to buy any more. This time, I kind of want to keep track of what things do I want to buy more of, and try and prioritize it, try and rank order. I still want to buy Finance of America companies. Now, it is an 8.3% allocation, and this consolidation period is still happening. I have a strong suspicion that it could sell off on the next earnings report, because with the rising interest rate, there could be a mark-to-market negative there. But yeah, this is a huge run-up. from $5 to $33. And then this consolidation period in the bull flag, that could last a while. It could last a few more months. I'm not eager to buy any more of this right now, so I want to buy more Finance of America companies. I just don't want to buy this instant. I don't want to miss the next leg higher, but I just have this strong suspicion the next earnings call is going to disappoint. The earnings call after that is going to be very, very bullish. So this is 8.3% of the portfolio. I do want to buy more. I just don't want to buy more right now. Let's see. Does Monument Mining. So this is now, how much is this? 3.4% of my portfolio. And I do want to buy more. And I want to buy more before the next earnings call, because I think this next earnings call could be a real humdinger. And for those of you who have been paid subscribers to my Substack, you'll know why. And also, it's not really all that much of a secret. This one I would buy more. I didn't buy anything this week. This week I took all the cash from rolling puts and I just delevered a little bit. I mean, there's a lot of things that I want to buy, but also sometimes I want to make sure that the leverage doesn't get too far ahead of me. This is 3.4% and I would buy more today. It's getting more expensive, and I generally don't play earnings announcements like lottery tickets. It's not my favorite style of investing, but this one, and there is a lot of buy the rumor, sell the news, but I feel like this one has a pretty strong chance of having an announcement that's not priced in. You know, the stock is really just too small to be efficient, and I think that the announcement this upcoming earnings could be pretty monumental. Kind of pun on the name there. So that one I would buy more, and I would even prioritize it. Portillo's. So for Portillo's, this has been an aggressive run-up. It's at the RSI overbought, but notice it cracked above overbought. What day is this? In the $13 range. And so from $13 to $15.20, it stayed in overbought. And this is one of those phenomenons, or sometimes overbought just stays overbought and things keep grinding higher. I don't know how much longer this is going to go. On the MACD, you do have some deceleration here in momentum. So I feel like this is going to enter a period of consolidation at some point. But what's really bullish about it is how it blew past a lot of these resistance levels. Right, so you had a resistance level. Right, this was a double top here. It was from multiple top, right? 1, 2, 3, 4, 5, 6, 7, 8. I mean, this was a pretty strong resistance level at $14, and it did break above that, and it's been above that for a couple of weeks. So I think that will hold. And then where's the next resistance level? $17. So I don't know when it's going to get exhausted and start consolidating again. But it has some more room to run because there's no resistance really in between 14 and 17. Maybe. Maybe. Does that look like a line to you guys? Or is it this one? $16. You could draw these things anywhere. Technicals, I'm not particularly good at them. I try my best. Would I buy Portillo's here? So it is a 3% position. I really like it unless they destroy something about their winning formula. And I like it for the next 10, 15, 20 years. It's the sort of thing I want to just keep buying a little bit of and have it as a fire forget missile. But in the short term, with the MACD compressing and the RSI had overbought, I don't think I would buy more Monument Mining before I bought more Portillo's today. Sibanye Stillwater is a 2.5%. Yes, 2.8% allocation to Sibanye Stillwater. And it has, let's see, now it's been chopping sideways for a while. It's not at overbought. The MACD is not rolling over. You have this sort of double bottom here, maybe at you know, what is that? Something like 330. I could probably call that a pretty serious resistance line. Let's see, 1, 2, 3, 4, 5, 6, 7. I mean, this has been a pretty strong resistance line at $3.90 something for a while. It's above that. It would be interesting to see if this becomes the new floor, right? If we stay out of this area for a while. It's still well below its 200-day moving average. This is one where I wouldn't mind zooming out for a couple years. The price has just been compressing and compressing and compressing. Well, mostly because the platinum and palladium metals prices have been compressing. But what's amazing is that it hasn't been able to spend very much time above its 200-day moving average, very, very brief periods of time, and it's not even close right now. But the narrative on catalytic converters has shifted because electric vehicles are not the immediate future, and hybrids use more platinum metals group metals in their catalytic converters than internal combustion vehicles. But there's an awful lot of stockpiles from the COVID era to burn through, and that could take a year, that could take 2 years. But I think there has been some price action on platinum. Let me see. Where is palladium? I think it was yesterday or 2 days ago. Palladium had a 3% up move. Yeah, that's, I mean, it's quite a base. Palladium at just under $1,000. But I think what people are waiting for is $2,000 palladium, and that's entirely on how much is stockpiled, how much is being burned up for these catalytic converters. The big demands for platinum and palladium are in diesel trucks, and there was concern about diesel as China is switching to natural gas for their 18-wheelers, and then there's for internal combustion vehicles and hybrids. And we're still a couple million cars a year below our past production peak for internal combustion vehicles in the US, or for all vehicles in the US. I think it's really just about the stockpile that has to be worked through. That could take a year or two. But as this, you know, this palladium and platinum price, this is below the cost of mining for 2 out of the 3 major platinum mining companies. There's not a lot of platinum miners that are profitable at that price. So now, but the majors, they haven't taken any production offline. They've been so stubborn about taking production offline. And I know there's huge costs associated with that, but I think they all anticipated this low price to be much more temporary than it has been. And there's been, with the outbreak of the Ukraine war, some people are saying that it was Russia's Nornickel that's been, in the past, had stockpiled palladium and then dumps it onto the market when they need to raise cash. That this huge price crash in palladium would be Nornickel dumping. And I think that does make sense because Nornickel, as a byproduct, gets palladium, but they don't get platinum. It's just a quirk of the way that the byproduct metals are in that deposit. And the platinum price hasn't crashed. The platinum and palladium are substitutable. The chemists have figured out ways to substitute them back and forth. And the platinum price did not crash when the palladium price crashed. So the theory that it is really Russia's Nornickel dumping their excess palladium byproduct that they've been stockpiling, I think that does hold a lot of water. I think that is pretty plausible. And then for them to maybe at the end of the Ukraine war to stop selling palladium, not only that, but to rebuild their stockpile for the next time they have an emergency and need to dump again, you could see palladium get back to a $2,000 an ounce price, and that would make all the 3 major platinum group metals miners dramatically profitable again. So we'll have to see. So Sibanye Stillwater, it's a 2.5% position. I would still add to it. I mean, this chart isn't telling me anything about the technicals that it's about to break out, but I would still add to it. I think it has room to grind higher, right? The RSI is not overbought, and the MACD could stay positive for a while here. So I think it could still climb a bit higher in the short term, but I would be buying this more in the fundamentals, not the technicals. Equinox Gold, that's about a 2.25% position for me. And that's pushing right up on the top end of the Bollinger Band. It was almost into overbought, but the MACD isn't really close to rolling over yet. I think it could go a good bit higher. Gold is at $2,900 an ounce. I think a lot of people predicted that for 2025, gold would maybe take a break and chop sideways. And for it to continue this aggressive bull run even higher, I think caught a lot of people off guard and surprised them. In the past, miners' costs of production rose with the gold price, and so they didn't stay profitable for long. In this case, I don't think the cost of production can catch up to this gold price. And especially if it's a Canadian miner, when you have this weak Canadian dollar, because they're paying their salaries in this massively depreciating currency. So they've got a huge amount of their cost structure that gets lower and lower, and the gold price gets higher and higher. And I have to double check because I have some Canadian energy companies also. Some of them have more Canadian denominated debt than others. But the more Canadian denominated debt just gets destroyed by this rapidly weakening Canadian dollar, the better. So this has broken above, right, this past triple top. Yeah. So Equinox has broken above that triple top, and it's staying above it. And it might consolidate a little bit here, having just touched the 70 on the RSI. But this is a very bullish, I mean, this base has been from April to February, right? So that's a huge base for this. Like you had that price run up, and then you had this huge base, and it's breaking out. So I think all the gold miners are buys right now, and I think yeah, it's painful to buy something after it's already started running a little bit, you know, because if you had bought at this peak in the past, then you crashed again. If you bought at this peak and you crashed again. But I think this might be a real breakout, especially getting past that previous triple top. Just check and see what it looked like over 3 years. Yeah, so there was a high in 2022, but aside for any near-term resistance, yeah, that's the same triple top back to April. Yeah, there's just not a lot of resistance. I'd have to go back even further. Yeah. Now, some people criticize technicians when they look back so many years for these various double tops, says they, you know, the market can't possibly remember, and people were doing it recently for the Japanese stock market after 40 years. Oh, people can't possibly remember that. But just back to 2021, I mean, there could be people who bought Equinox Gold at $8.50, and they've been just sitting and waiting for years to say, if I get back to break even, I'm selling. I think that's highly possible, right? I mean, because I've made bad purchases like that before. And this this double top at $8.50, I wouldn't be surprised if Equinox ran up to that level and then took a pause there, because you are going to find people that bought, especially in this range, right? People who bought all through this area here, between $8 and $9. They're just, you know, saying their prayers every night, saying, if I could just break even, I'll exit and I'll never buy a gold miner again. And so there was a lot of volume. What is this? From 2021, from February all the way to 2022 in June. I mean, that's almost a year and a half of people that say, if I could just get back to break even, I'm happy to get out of this thing. So there could be a
a resistance line there. I would buy Equinox Gold, but right now I'm still prioritizing Monument Mining. Let's see. I own way too much energy. I really don't want to buy any more. But this Valeura energy that's mining in the Gulf of Thailand is really something else. And it had this huge run-up, and it gave some back. It was pretty well behaved. It only briefly went below intraday, below the 50-day moving average. This has been very well behaved. It touched the 20-day moving average, touched the lower end of the Bollinger Band. If anything, I think this is probably a buying opportunity. I might be early on that, but I think that I just own so much energy, but I would still buy more of this. It's such a great company. Douglas Elliman. So Douglas Elliman is a 1.5% position. It's just started holding above the 50-day moving average, and that's about to turn up again. And well, this one is going to be very interest rate sensitive, and so as the interest rate, if it does continue coming down, even though it's not really in the charts, but both Scott Bessent and Trump have said that their current focus is on this interest rate. And I do think there are things that they could do. And this is going to be highly interest rate sensitive. So I could buy more Douglas Elliman here. It's a 1.5% position. Titan International. So Titan International, it's about to have a golden cross. So as this 50-day moves above the 200-day, that's going to attract a lot of other technicians to find the stock. It's run up from about 6.5 to about $9.10. It is above this, that was, it's only slight, I mean, it's not exact, it's not perfect, but this is double top, triple top, quadruple top, somewhere in here. It's not a perfect resistance point, but it's slightly above that. And when the 50-day moving average crosses the 200 and you get the golden cross, that's going to show up on a lot of people screen for golden crosses, and that's when they jump in. I think Titan International has some really good room to run in front of it, and have to move back a little bit to see how far the stock price sold off. Yeah, so this was a $15 stock before its acquisition, a recent acquisition knocked it down to a $6 stock, and the crash was so steep. There's not really any solid resistance points now between 9 and 15. Well, there might be a few things from this run up. Yeah, this is pretty darn bullish. I like that. Titan International is a 1.4% position. I could see myself buying more. That's a pretty attractive one. Heartland Express. There's just nothing on the technicals that are attractive. If anything, the 50-day now is below the 200 and diverging. So if anything, it's just a tiny bit bearish. I like the company fundamentally. I might be early on this one, so I probably wouldn't add any more right now. Cardlytics is still in no man's land. Yeah, look at that. I mean, this has been a consolidation range from August to February. So at some point, if it has any fundamental improvement, it'll break out. But I have a small position, and the torque on this, if it performs well, I'm glad I have a small position, but because there's very few stocks out there that really have the potential to be a 50 bagger. And Cardlytics, Open Door, and maybe less of extent Teladoc. More Cardlytics and Open Door, they have the ability to be a 50 bagger because of the size of the market and the moat they have in it. They really just need to perform, and they haven't been doing it. Abacus Life. This was a new position I just started. I started it without regard for the technicals. Wow, look, I gotta zoom in on that candle. Go to that 3 months. Look at that candle. That's for today. That's a battleground from $7.20 to $7.95, and for it to be right in the middle where it opened. You don't see a lot of, I mean, that's a tug of war, right? That's two sides, you know, two opposing sides on a rope just pulling against each other. You don't see a lot of candles like that. That's a pretty amazing phenomenon. I like this for the long term. In the short term, I think the multiples are a little expensive in the short term. It's really relying on a lot of growth. I think they will have that growth, but that means that I'm less confident that the price couldn't fall on me. You know, sometimes I buy a stock and I just know, you know, it could get cut in half. But I had to start the position anyway because I really like the theme, I really like the company, and I like the management. And it also could have just, it has the risk it could also just keep, the price could keep running up. So I didn't want to sit around and wait for something to happen. But the chart, it's not a screaming buy, especially with the 50-day so far below the 200-day. I think it'd still spend a few months consolidating down here. So it's not a screaming buy. Alta Equipment Group, this one has been consolidating longer, but it's still not a screaming buy. Peabody Energy. The bottom might be in. It was at a $16 range. I think it was even below $16 for a day. I think the company is just so large on a price to sales basis, and with so much money to spend on share buybacks for the price to be that low. I know the acquisition was hated, but I think a huge chunk of this downward momentum is momentum traders. And a lot of them, when it broke below 17, there were a lot of Peabody Energy shorts that announced on Twitter that they were covering their short position around 17. I think the momentum might have changed here, and I think I put the initial buy order on it like 24, because this was a place for an inflection. This inflected downward. And then I personally bought a bunch more, I think at this 1950 range. So I think this is where I did some buying, and that was a bull trap, right? So that was a pretty clear bull trap. And I've been trying to figure out how to spot the difference between a bull trap or a real reversal. And one of the things to watch out for is volume. So the volume on a real reversal is higher than a bull trap. Let me take this volume and put it below instead of behind. So this volume spike, I mean, there was a volume spike there. So it's not a perfect measure, but sometimes you can spot a real reversal because of a volume spike. So I think odds are better that this is a true reversal and that the pain is over because the volume is higher than some of these previous peaks. It's not truly aggressive. Let me check out on the S&P 500 and just show you what I was talking about here. So in fall, I think it was in December, or was it this one? One of these recent spikes, I had put out a Substack post, and I was trying to answer the question: was it a bull trap, or was it just going to was it a bull trap or a reversal? And you could see that in a lot of these spikes. So when you're on this day here and you have this huge volume, that's a pretty good indication that it's not going to keep on falling. That's a pretty good indication that it's not a bull trap, that it's the true bottom has been found. But that signal doesn't hit every time. So that signal didn't really hit here. It didn't really hit here, but it did hit here. And so that gave, this wasn't the exact bottom, but it also didn't crash significantly from there. And then from 585 to 575, okay. So both of these huge volume spikes those were safe places to buy. Let's see if Peabody Energy shows anything like that. And maybe. I mean, you can kind of see that the volume here is about 8 million shares, as opposed to here it was maybe 6 million shares. It's not conclusive. It's probably correct, but it's not 100% conclusive. Right, so this was an okay spot to buy on that volume spike. This one, not so much. Anyway, we'll leave Peabody Energy out of it. I'm not buying. It's not a huge position. I could buy more. Fundamentally, I just don't like their acquisition. I would probably buy Warrior Met Coal instead, because Warrior Met Coal is at this consolidation price level, and their management's not making mistakes by making these aggressive acquisitions. So if I was going to buy a coal company, I would buy Warrior Met Coal, because it's in this consolidation period, and when it breaks out of this, probably when their new mine under production reopens, it'll bounce back to, you know, $70, $80, $90, $120. It's going to have quite a run when it reopens. So I think everybody that's buying Warrior Met Coal knows that it's at least a double or a triple, and this is a fantastic place to buy it. So I would buy Warrior Met Coal before I would buy BTU, Peabody Energy. Centrus Energy. Look at that chart, and it just cracked up from this $80 range up to the $120 range again, and it does have the double top here. So I've got that now double top formation. It just hit overbought again. It just had that huge volume spike. It had an earnings call that everybody liked. But one thing that was interesting on it is, so if you look at their earnings versus their so they made some money just selling some inventory while prices were high. I know that uranium ore prices are not high. Uranium ore prices are struggling. But Centrus Energy had an inventory of uranium hexafluoride, and those prices were very high. So their earnings were a beat for this quarter, but a huge chunk of that was opportunistic sales of inventory, that they do have some more inventory to sell, but I don't know, management did not guide on 2025's earnings. So earnings might not be growing all that rapidly. This is a company to buy for the next 5 years, not to buy for the next 2 quarters. So I wouldn't be surprised if, and also compared to its current revenue, the price to earnings, price to sales is pretty rich. It's kind of based on existing revenues and profits. It's priced along with its peers in this nuclear defense contractor space, like BWXT. It has exactly the same multiples as BWXT, but there's a chance that earnings could fall in 2029 or 2025. So this is a company to buy for 5 years. I don't know if the price is going to keep rallying any higher. This is something that I think, I don't know if I would buy more here with the RSI and overbought. Yeah, that's a tough sell for me. I put it on my Substack at the $35 range, and it's been very pleasant to have this triple. But I don't think that I would buy more here. I think I'd like to see what happens either when they run out of extra uranium hexafluoride to sell. Although the other side of that argument, so they've won 3 Department of Energy contracts, which are designed to reinvigorate domestic uranium enrichment. As those work orders get doled out, if they are significant enough, if they represent significant revenue, that would be a game changer. But it's some of those things, so that those Department of Energy contracts, those are 10 years long, and I don't know at what speed that $3.4 billion is going to be doled out. So Centrus Energy just deployed $60 million to start the process, to start a 42-month process of getting their enrichment cascade online. So you're talking about 3.5 years. You're going to do the CapEx now to have product roll off the line in 3.5 years. I am not confident that the stock price is going to only go up during that time period. So yeah, this is still an expensive stock for me right now. I have a 1% position because it was a 1/3 of a percent position before it tripled, but I have a hard time buying more. Applied Opto, yeah, it's a pretty clear-cut bull flag still, right? Had this huge run-up as the consolidation period. There was a short report, so a company did put out a short report on this stock. I skimmed through it, and there was some failure to perform in past cycles. I don't know if that's going to haunt the company. It wasn't the most convincing short report I've read, and the data center build-out and the contracts this company has are pretty impressive. So, and the day of the short report that it was released, the stock ended green for the day. So the market didn't really take the release of that short report too seriously either. This is not a comfort. There's so many other things that are cheaper. I don't know if I would buy more here. NRDY. NRDY is a fantastic chart. It had the golden cross, but it hasn't really broken out much yet, and the CEO founder is still buying more. I would buy more NRDY. ARS Pharmaceuticals, a good company below its 200-day moving average. I would buy more ARS Pharmaceuticals. Let's see. SoFi. So I did go back and I reread my fundamental analysis on SoFi from when I wrote about it when it was $7 a share. And based on its growth, I put a price to sales multiple. I said the price was going to end up somewhere between 14 billion and 21 billion of a market capitalization based on its price to sales multiple. And it's there. It's exactly there. Now, I'm not selling because its growth rate is still higher than the S&P 500. But I also don't think I would necessarily add up here either. So my SoFi position, it's about 2/3 of a percent. It's not a huge position. I just went back and reread my own fundamental analysis, and it's reached the price target. Now, one of the things about a bull market is things can become, the valuations can get absurd. And SoFi, it has this really enthusiastic following on Twitter, but the price isn't at like Palantir levels or Tesla levels. And I don't know if that's because it's a former Chamath Palihapitiya SPAC or whatever the reason is. Even though SoFi has a lot of enthusiasm on Twitter, it just doesn't have the same. Right now it has multiples exactly of a tech company at its growth rate. It doesn't have any premium for having a cult following. So does this thing have room to double because of that cult following premium? It could. That's not a thesis that I would buy more on. I'm not selling any of my SoFi. At least would wait until it's a long-term capital gain, and that's going to be toward the end of the year. So yeah, I'm not looking at selling. It's just a hard sell for me to buy more here. Energy fuels. That is an ugly chart, and you just had a death cross. The 50-day just fell below the 200-day moving average. And this company is still a couple years away from its, huge monazite pipeline coming online. But at the same time, rare earth is becoming such a more important topic of discussion now that we are, in this sort of rivalrous relationship with China. Uranium prices are low, and they still have 4 uranium mines, I think, that they can be brought up to speed pretty quickly. So they talked about having being able to mine an extra 1 million pounds of uranium a year for every $100 million they spend on reactivating old mines. And that's a really good return on investment compared to all the companies that have to build a new mine from scratch. And uranium prices are low now, but I don't think uranium prices are going to stay low. So they're a couple years away from their rare earth business model, but their uranium business model is a lot closer. It's an ugly chart, but I wouldn't be against adding more. Jack specific. That is, you know, a nice chart grinding higher. It has periods of consolidation, right? So you've got the rally, the consolidation, and now are we off to the rally again? I think we might be. And so Jack specific, it's a toy company. They have their baseline toys, but then they also do really well whenever a movie comes out, because they do the movie merchandising as well. And Moana 2 was released. I think Sonic 3 was released. The stock price was really in the dumps. Disney's Wish was a bomb, and the merchandise didn't sell. So if Moana 2 and Sonic 3 are not bombs and the merchandise sells, they'll do well. And they also just got a contract to do the costumes. They do the Halloween costumes for different intellectual properties. They just got the contract for Minecraft. I was at the park the other day, and there was a 7-year-old's birthday party, and I don't really have a good appreciation for how popular Minecraft was, but at that 7-year-old's birthday party, man, those guys were all about Minecraft. So I'm a little out of touch with children's toys. I have a 5-year-old and a 2-year-old, but mostly I just buy them Legos. I'm not really in touch with what's popular for kids, but I think that new Minecraft contract, Moana 2, Sonic 3, plus the technicals, it's overbought, but sometimes overbought becomes more overbought. And sometimes it doesn't. Consumer discretionary is the other sector. There's only 2 sectors year to date that are below the S&P 500 average, and consumer discretionary is one of those 2. So you've got the RSI and overbought, consumer discretionary underperforming, but you're kind of, is it, maybe it's not above, right? Maybe it's making a double top. Let me see. What do you guys think? Maybe tell me in the comments. Is this a double top, or is this breaking out of its consolidation period? Oh, right. Which chart is the correct one? Is it this is a double top and then it's on its way down, right? So it's going this way, or this one in red. Is it right bull flag and then on its way this way, right? So which one is the right answer? Is this a bull flag breaking out, or is it a double top heading down? I don't know. It's very tough to say. I still like Jack specific fundamentally, but I'm not sure what to make of that chart. Perspective Therapeutics. It's still at the same part I bought it at. It's a 2 or 3 month consolidation period. Consolidate for a few more months. This stock is going to move on the next release of one of their drug trial studies. They had a drug trial study released, and the market interpreted it as bad, but there was a whole bunch of insider buying. So the insiders didn't interpret it as bad, and they talked about that on their call. They said, look, this is a fantastic outcome, because what's really important was that their drug did not destroy the kidneys. So it wasn't, I think the market was disappointed that it didn't cure every case of cancer in the study, and the medical researchers were thrilled that it didn't blow up the kidneys of the people that they prescribed it to, because as long as it's safe for the kidneys, they can up the dosage. And the drug trial, as it continues, has higher and higher dosages. So what the researchers were looking for and what the market was looking for were very, very different things. I still like it. It's a small position. I don't know if I would add more, because I think I'm going to get caught up in these gold miners while the price of gold stays high. FTC Solar. Oh, you've got a death cross. You've got it getting to be oversold in RSI, and you've got it on the lower end of the Bollinger Band. You've got a resistance point here. What is that? About $3. It was below that previously. It was down here at 2. Probably that $3 range will probably hold. This is FTC Solar. They've done a lot of hiring in their sales department. And solar is one of those things that's very contrarian right now, because the states and countries that are not fossil fuels rich might still implement a pretty decent solar build out. The economics on solar is not nearly as bad as the economics on wind. I mean, wind is just really taking taxpayer wealth and destroying it. Anybody who's pushing wind should just be it's an obvious grift. Solar, the economics are not nearly as bad. They become as bad when you have to take energy storage into account, but aside from the energy storage, the grid can handle some modest amount of solar. So that solar build out could continue, especially in countries that don't have a lot of fossil fuels. And FTCI has hired a huge sales team to try and land these contracts. I'm still bullish, and especially the backlog they have compared to the market capitalization. I think I probably should be buying a little bit more of this. And then, let's see. Burford Capital. Oh, I had meant to buy more, and I didn't buy more. It's not too late. It's not even close to too late. But this is a breakout, right? This is a breakout past at least the recent resistance was that double top, and it's broken out above that. I just have this strong suspicion that at some point soon in the year, they're going to have a settlement with Argentina over the YPF lawsuit. And I think it's in Argentina's best interest to do it, and I think it's going to happen pretty soon, especially where Javier Milei even said that they're going to the debt markets to issue new debt. I think they'd get a better interest rate on that debt if they just settled this lawsuit first. And so this is a pretty aggressive run-up. Right, you've got a very small consolidation period, and then the run-up continues, and it is a steep run-up. It just hit overbought. It hit overbought here. Leave all that stuff off. It hit overbought here, had a very sharp consolidation period. It wasn't even a 50% retracement. It was like a 25% retracement, and now it's off to the races again. It's back up to overbought, but it could become more overbought. And the MACD is turning up, not down. So yeah, it's not too late. I think in my post for 2025, what am I most bullish about? What am I most enthusiastic about? Burford Capital is one of the stocks that I really, really, really want to add more, and I just haven't prioritized doing it. Kind of kicking myself for paying down margin instead of buying more Burford Capital last week. But that's a breakout, and I think the market's starting to sniff out that this lawsuit is going to get settled sooner rather than later. I would really be surprised if it went beyond late summer of this year, because another thing is the amount that Argentina would have to pay to settle would increase if their final appeal is lost, right? So every time the case progresses to another milestone, it becomes more and more expensive to settle and gets valued higher and higher by this litigation company, so that they're running out of time to negotiate it at a cheaper price, because that appeals court, my best estimate is, and I'm not very good at estimating this, that they'll probably be done with that final appeal by the end of this summer. So, and Argentina has a budget surplus. They could start paying this. They could come up with some sort of payment term system, and it would help them raise debt more cheaply if they settled that. And the next question is, when are they going to do it? And a lot of Argentinian politicians have admitted publicly that this is a debt that they're going to have to pay eventually. And the question is just when. But yeah, it's breaking out. But Newell Brands is breaking down. Oh, this was a surprise because this last quarter, this was Christmas, and they were, positive earnings per share, pretty significantly positive for the quarter, but they guided toward a loss for next quarter. but it's a seasonal business, right? You sell more during Christmas, and this sell-off was so aggressive, from $10 to $7. That was a really aggressive sell-off, and that surprised me, because this company is now on 6 consecutive quarters of improvement, and I did not expect a company on 6 quarters of improvement to keep selling off that hard, right? So this is, I mean, this was a breakout. This was a breakout that just got cut off at the knees, because this was a bullish chart, right? I mean, you have this crash. The company has had 6 quarters of consecutive improvement, right? You finally reached the bottom in July of 2024, and you're on the way up, right? You're making higher highs, you're making higher lows. It's fantastic. And then on one earnings call, it just gets cut off at the knees. I don't even think the earnings call was that bad, but it just happened to be that earnings call was the exact same Friday that this inflation report came out. So the market was looking for something to sell off, and boy, did they sell it off. Because the dominant story here is it's 6 quarters of improvement, right? They're turning the ship around. This is such an aggressively oversold position. I mean, I think, not technically, but just as a value investor, this is a great time to buy it. I mean, this is going to be a $25 stock when they return to growth. And the management guided a return to revenue growth within 2025. So this is probably, maybe 2 earnings calls away from really taking off. And I think this is a fantastic entry point, but this really surprised me. I mean, that was really a massive sell-off from $10 to $7. 30% down in one day on a quarter where they beat. So this is a quarter where they had an earnings beat, and the market just, I don't know. And again, from a technical perspective, how do you see that chart and not think, okay, here's the breakout, right? It's time to pile in. So painful, so painful. Newell Brands is still probably one of my favorite mid-cap turnaround stories. Management's doing all the right things. Management's getting results, but the market did not like it. It's really shoot first and don't even bother asking questions later. It's just shoot first. Ask questions never. So that is, it just couldn't be more painful. Having a position fall 30% on an earnings call where they beat earnings. That's why I don't like earnings calls. I don't try and play the earnings announcements, the earnings events. And but despite that, I would still buy more Monument Mining here. I would absolutely buy more Monument Mining. So hopefully I have a chance to do that before the next earnings call. Anyway, this has been going on long enough, and thank you guys for listening. This is the Unemployed Value Degen. Just looking at some technical charts about where do I want to deploy a little bit of money for the week ahead. This is not financial advice, and I hope you guys have a great week. Thanks.